Hi, Dominique, and welcome to another edition of The Week Ahead. Hope you're doing well. How's everything going?
Very well, Andrew. How about you?
Good, very good, thank you. Okay, let's kind of dive right in. And as we always like to do, let's go through market reactions, general market reactions to any Fed comments, employment growth data, obviously now maybe some issues in politics, particularly in the US around the debt ceiling. Kind of what were your biggest takeaways from this past week?
Okay, so the biggest takeaway is that we are in a holding pattern. So Fed-wise, data-wise, let me explain a little bit. Data-wise, there is this risk of impending credit crunch. And so far, the data shows this is not happening. In fact, the latest bank balance sheet data we got showed a healthy growth in bank lending, 1.6 billion over the week. Deposit loss is mainly large banks and linked to QT, that is continuing. I look at CD rates, retail CD rates, for signs that banks are desperate to keep their customers, which is what I read in the news media, by the way, and I'm not seeing those signs in the data. CD rates have gone up by about 1.5% in the year to February or March, and they've been flat ever since. I'm not seeing the spikes that would tell me that banks are bleeding deposits. So nothing to see there. On the data, also nothing decisive in terms of, deciding whether we are truly on a inflationary trend or whether inflation is picking up. Not much happening there. Surprises one way, the other way. The surprise index is almost unchanged from a week ago. The Atlanta Fed nowcast, which is my preferred aggregator of macro data, shows a first quarter GDP at 2.5%, so above trend of 2%. So not much exciting. In terms of the debt ceiling, this is something that's going to be decided at the last minute, following several rounds of brinkmanship. And the X day is likely to be over the summer. So, we're getting some comments mainly from the Republicans who want to show that they're tough, but nothing happening, and nothing won't happen for a few months.
On the debt ceiling, I saw something that McCarthy was presenting, kind of their own proposal of, I guess, changes to the existing budget outlays that were agreed, 6 months ago. But in the end, he doesn't seem to have the votes. So does that mean that if that's true, first, if that's true, and then two, does that mean that takes away the power that he has? Does he need to pass something in order to actually stop the process?
So basically, what the Republicans want is to get the Democrat to agree to serious fiscal consolidation in exchange for raising the debt ceiling. The most likely way to do that is to convince the Democrats that they don't care. If they can't get the fiscal consolidation, they will let the US default. And so the issue is, how credible are they? And if within their own caucus, and they have a very small majority, they have people who disagree with that strategy, obviously their credibility is blown out of water. Right. So far, I don't think Speaker McCarthy has added to his credibility. I think that his inability to get the votes for this bill just shows the risk that a few, all you need to raise the debt ceiling is to have a few centrist Republicans who are running in marginal districts to vote along with the Democrats. So
what percentage of the vote do they need? The Democrats need just to pass this to not have an issue then, yeah.
They need just to have enough of a majority in the House, and I forgot what the numbers are, but I think the Republicans have a majority of 5.
Okay, fine. So it's not, yeah.
Small. So to start with, they don't have a strong bargaining position, and then if they can't agree on a common position, it makes it even less likely that they
right.
will.
And then just 2 minutes on the technical question. I have been reading that there's a series of tax inflows, I guess maybe personal and corporate. And so so there's a point where the government or the Treasury actually does not have enough money to make outflowing payments.
Mhm.
But if that doesn't, which could be even in June, but for a short period of time. But then the real issue is more sometime July, August. Is that right?
So
See that as a threat.
So it's kind of hard because the process is not exactly transparent. The Treasury is using so-called extraordinary measures, where basically they substitute debt that is not subjected to the ceiling to debt that is subjected to the ceiling, and they are not telling us at all how much of that they have done and how much more room they have. So yes, there is a little bit of an issue of, that substitution happening at the end of the month, and whether the balance of cash receipts and payments will be enough to tidy them over the month. It's hard to know. I would think, that there is a war room as we speak in the Treasury Department, and people are trying to figure this one out. But in terms of, the X day, which is the day when the US government runs out of money, it's more likely to happen over the summer than in June. I'm actually working on this and will publish some estimates this week.
Awesome. Okay, so then if I kind of put a lot of your views in general, outside of that, the growth is still slightly above trend, which has definitely been your call for a long time. And a lot of the markets have disagreed, but it's continuing to be that view. You don't see some massive issues either way, i.e., you think we're generally in this kind of higher inflation, strong above trend growth, and the fact that I guess equity and bond markets, especially equities, have been somewhat in this holding pattern. You can see by the VIX, or just in general, even not just spot VIX, but further out, that markets are probably reacting. Makes sense right now that until we see a potential massive drop off in growth, or the Fed changing their policy, which looks like they're trying to say it maybe just one more 25. Now, your view may be that one more 25 may continue to be one more 25 for many more meetings. So I would say it sounds like markets are reacting kind of how you thought, outside of these little kind of 20, 30 bip blip moves either way, like when we were joking about recession 4.0, a couple of weeks ago. Anything in outside of the debt discussions, anything in the near future, in the next 1 to 2 weeks, do you see that could, I guess earnings is a big thing, would be for equities, but in general markets, do you see any big risks either way? So like the inflation looking like it's really accelerating again, or growth absolutely collapsing?
So to me, the biggest medium-term risk is oil prices, because the economy has so little spare capacity. In fact, you have enormous resource pressure. Unemployment is the lowest in 50 years. So if in that context, if you have an inflationary shock, it's going to spread to the whole economy very quickly. So to me, that's the most important risk. My best case scenario is that, as you've explained, things chug along, inflation doesn't slow down much. In fact, the Atlanta Fed median wage perked up in March. If you look at the median price CPI or even the median price PCE, that are the better indicator of inflationary trend, they are stuck where they are. So I see things chugging along until the end of the summer, when the hawks on the FOMC turn around and tell the doves, look, we've been waiting for your crippling credit crunch. It's not happening. Meanwhile, inflation has made no progress. And in fact, we can see signs that it could be about to accelerate. We have to resume the rate hikes. That's my scenario, a boring summer, basically.
Right, a boring summer, but
Except for
in
the
some
debt,
cases frustrating. Sorry, you're saying?
a boring summer, except for the debt ceiling, because the only way this thing can get resolved is through several rounds of brinkmanship, where you'll have the administration saying, look, if you want to telling the Republican, if you want to push the government into a default, do it, but we shall stick to the principles that we should honor our debts and we will not engage in this ridiculous fear tricks. And then the GOP will say, you know, how dare you endanger the future of American generations with this irresponsible fiscal policy, blah, blah, blah. People will get worked up. They're more than they are now. I think in a way what people are getting worked up now because they don't see any action. But, you know, the stress will rise as we get closer to resolution. And who knows, there might even be a technical default, for, you know, for a very short period of time. But do you seriously think that the United States government is not going to pay its debt? Of course not.
Right.
Though you could do quite a bit of damage with volatility. But I can't imagine anyone serious thinking that, you know, the US is going the way of Russia and suddenly deciding it's not going to pay its debts. Come on.
Yep. Okay, that's great. And makes a lot of sense. Okay, so let's move to the week ahead. What are the things outside of the political discussions in DC? What are the things you're looking out for? And then obviously our investors should be looking out for. And I guess probably to keep in context of these kind of MIDI swings between, you know, growth is collapsing or, you know, or inflation is collapsing or it's not. What are the key points, key data points coming out?
Okay, so with the Fed, nothing because it's a blackout, but we will get a Fed balance sheet, we will get a commercial banks balance sheet, money market fund balance sheet, and we're going to get what we have been getting for the past few weeks. That is nothing much, stable deposits at small banks, falling deposit at large banks because of QT, higher lending, lower cash holdings, lower bond holdings. So not much there. And money market fund, by the way, the inflow this week were actually negative. People took out money from money market funds. So small inflows, perhaps outflows. Yeah, but there's no crisis. Okay, so the important part is going to be the data. So in terms of data, we are getting the Fed preferred measure of wage inflation, which is called the Employment Cost Index. And the reasons I like it is that it takes into account changes in the distribution of employment. What I mean is that, for instance, when you have a large increase in employment in low-paid job in hospitality or retail, for instance, it biases down the average. And so what the ECI does is that it corrects for these changes. So the Fed likes it. I think the market is a little too optimistic. If you compare the Atlanta Fed median wage, which is the same type of measure but monthly, it's high, it's quite high, and the consensus of 1.1% for the ECI quarter on quarter seems a bit low relative to where the Atlanta Fed has been. So I see a potential for a positive surprise there. Then we have PC, but PC inflation is never as big a deal as the CPI because it's usually quite, the potential for surprises is quite small, given other price releases during the month. As always, I will be looking for the median price PC as a more reliable indicator of trend, and I will expect not much of a change relative to February. Then we get the GDP, and of course it's a backward-looking measure, but it sort of gives us a sense of where we are in the cycle. I agree with the consensus. I am also expecting a recovery in GDP, excluding inventories and external trade, which is a more stable form of a GDP measure. It's called final sales to domestic purchaser.
Right.
Would like to see a recovery from the 0.7% Q on Q SAR we saw in Q4. That was quite low. We get house prices there again.
I see it's also personal income and spending. Is that a big one as well?
Long term, yeah. I mean, in terms of my big picture, because my optimism on growth is really three things or four things. No banking crisis, super loose fiscal policy, and that I think the CBO in a couple of weeks is going to revise up its estimate of the deficit, which is currently 4.4% of GDP, which is crazy when you think about the fact that the economy, there is so much resource pressure in the economy. I mean, it's anyway. So I'll just say I won't say more. So the reason for being positive on growth: no banking crisis, humongous deficit, loose monetary policy, because we are still well below the Taylor rule, no matter which price index you use to compute the Taylor rule. And we have a recovery in household savings that is very gradual. So I'm expecting that recovery to continue. If suddenly household got panicked by, say, the banking crisis, and they hiked the savings rate very fast, currently it's about 4.5% against 7-8% before the banking crisis and before the pandemic, because the pandemic destroyed everything. If there was a very big increase, that certainly would make me change.
That's a good thing to warn about. Okay.
Yeah, an inflation outlook. So it's important in the grand scheme of things, but in terms of changing things in the short run, actually even the employment cost index is not going to change. Like the Fed, the next meeting, they are going to hike 25, there is no surprise. And then they are going to signal that they are on hold, waiting for the famous credit crunch to happen. Other stuff that's interesting next week, house prices. I think there again, there is a small scope for a positive surprise because the consensus thinks prices are going to go down. If you look at sales, they've actually recovered. There was a small decline last week, but the trend, I mean, there's been really a change in the trend. It's we are in a more stable pattern, maybe not
Yep.
increasing. And given the way the real estate market is adjusting this time around, where people are deciding to list or not to list based on price behavior, I think the stabilization of sales suggests a stabilization of prices rather than the small decline that is a consensus. What else? Consumer confidence. So it's one of those things that are in the Bloomberg calendar, so that I'm commenting on. But the relationship with hard data, for instance, with durable purchases, has been completely destroyed by the pandemic.
Yeah. I was going to say, I always think of you when I see these soft data and the market reacts, and your thoughts on that basically correlation is broken down. So it's interesting to be aware of these things, because for a few hours of the day it could be market moving, but in reality, if the relationship with hard data is not there, then the value in it is definitely not as good. I guess last one I have is jobless claims, because that seems to be ticking up a bit. Still well below where it was pre-pandemic, which is amazing considering everything.
So 100%, but I'll say this: there is a big difference in the pattern of jobless claims, seasonally adjusted, which is what everyone is talking about, and non-seasonally adjusted. Non-seasonally adjusted, there is much less of an increase, which doesn't mean that the seasonally adjusted data is not valid. But if you look at it, basically what it shows is normalization. So we are actually moving back to where we were before the pandemic, from below. So we are moving from a superheated labor market to a very heated labor market. And to me, that's one of my frustration, and because I can't seem to get this message across. Typically, when you have a recession, the government gives a little bit of money, eases policy, but not enough to offset the loss of demand caused by the recession. So what happens is that, for instance, with employment, it contracts, and then it's very gradually starts increasing. But you have a really nicely shaped concave curve. And employment growth converges to trend from below trend. But this time around, we had such crazy, and I cannot find terms strong enough, but at the same time, that don't make me look extreme myself, to describe the policy easing we've had. So we went from 5% contraction in employment growth to 5% increase. So we are converging to trend from the top, from above the trend. And what I think confuses many people, they think we are actually slowing down and we are headed to recession. But no, we are just digesting the consequences of completely extreme policy easing.
Right. Okay, awesome. Okay, that's great. Thank you very much. All great insights, and certainly, as always, gives our clients, investors, the key things to think about. I'll just quickly go through some of the publications we released just this past week. I'll break it down for our Prime members. So if you're a Light member, or you're not a member at all, you want to consider, we put out amazing stuff on Prime. Just go to the website. You can check that out. The first month is free, by the way. So Bilal wrote a piece, 5 failings of ChatGPT and generative AI, which is obviously super topical everywhere. And I would say even within Macro Hive, the past few weeks, we've really been thinking about how do we use this technology to improve all aspects of the business, which is super exciting. John Tierney talks his views on equity positions, how we recommend to be positioned best, and with a focus on staying long financials. which fits obviously, Dominique, with your views, and Richard on the G10 FX Weekly. Again, this has been really becoming one of our most popular pieces, weekly pieces, and has had some fantastic calls across the G10 space. And on professional, Henry is back in the seat and super excited, and our clients are really benefiting from that. So he releases ECB Monitor, really breaking down the different patterns and views and insights from the ECB, and how we're definitely targeting 50 basis points for May and a 4% potential terminal rate. From Mustafa, he put out, his global rates weekly, and he I think, like we all agree, like this debt standoff is probably different than ones we saw kind of 10 years ago, just because the markets are just, and the US in general, but the markets are probably much more fragile than they were then. Obviously interest rates are much higher as well. And Dominique, your piece, which I thought was great, on and you always get pushback on this, but you're continuing to be right, is a piece on the consumption growth remaining above trend. So thank you, as always. This is an awesome thing, and I hope everyone really appreciates it. And any parting words?
No, as always, please, to our viewers, please send feedback, critical feedback, most helpful, and good luck out there.
Okay, awesome. Thank you.